Howdy, Jacob here. Today we're looking at Mettler-Toledo International, company 84 of our high ROIC screener in the life sciences, tools, and services industry. Just under 28 billion market cap on just under 30 billion enterprise value, so a little bit of net debt there. The company manufactures and supplies precision instruments and services globally through 5 segments. Okay. Um, Revenue growth has not been incredibly quick, but very solid growth still. Return on invested capital growth is amazing. You're looking at low 40% average the last 3 years. So gross margin has also increased about 4.5%. Operating margin up almost 10% to 29%. That's absolutely amazing. Just know that that can be inflated due to buybacks. So let's see. Okay, looks like they're using all of the money essentially to repurchase shares, which inflates your return on invested capital. So keep that in mind. 70 million cash on hand with 1.9 billion in long-term debt. That 1.9 billion though is just over 2 years, between 2 and 2.5 years of their 5-year average free cash flow, and their free cash flow is absolutely growing. So we are seeing a little bit of reinvestment, but not a whole lot. There's probably 10% use, maybe five to 10% use of free cash flow on acquisition, and the remaining, if not more, due to them issuing debt, probably 105% of free cash flow is going towards share repurchases. So keep in mind that share repurchases can absolutely be advantageous to you as the investor and the shareholder, which means that you own one share, 10% of the business. Let's say if there's 10 shares outstanding, if they buy back half of them, you now own one of five, 20%. Extreme example, but the way to think about it more conceptually and accurately is that they can do anything with the money that they produce from the business. You want them to be doing what's most advantageous to get you the greatest return possible. And at these rates, we'll see if repurchasing shares makes the most sense. But if they're having the possibility of getting 20+% returns through reinvestment, that might be the most advantageous thing, and they're not quite doing that. So the first action for growing companies you definitely want to see with the high ROIC is them reinvesting as much as they can back into the business to get those elevated exponential returns. But buying back shares that are cheap can absolutely be advantageous. Let's see if buying back shares right now makes sense by evaluating the business. So on the revenue side, like I said, I don't think the growth is really absolutely crazy, but I do still think that there's a good amount of growth ahead of them. So let's say maybe 5%. And then they did have a great return on invested capital, but they're not reinvesting back into themselves to get those types of returns. So I'm going to put in maybe a little bit of a premium over the average company. I think at the end of 7 years, their growth will probably be pretty close to average of the market, which has a historical PE in the 15 realm. But due to them having the possibility to reinvest those massive rates of return, I am giving them a slight premium. And then on the margin side, 2019, let's do 21 and 20 since it has been growing. And then for share change, they're currently roughly 30 billion. Let's say they buy back 600 million. Yeah, I mean, 2% of shares buyback would be 600 million. And historically, they've done a bit more than that. So I might even do 2.5% of shares. That would be 750 million repurchases. And then that would at least give the company a little bit of leeway to not have 100% of their money going out on free cash flow to buying back shares, but keeping a little bit for acquisitions that are making the company more efficient through smart acquisition, not just buying back to increase revenue and such, but to really maybe increase revenue through making the company more efficient in the long term, increasing margins, or through reinvesting at massive rates of return. So I think I'm liking the assumptions that I have right now, and that's as it looks and appears right now, it's just a little bit expensive. So I'm just waiting till it gets to a more attractive price, but a fantastic company, one that I want to own, just at the right price. So thank you, and have a great rest of your day.